Good morning, everybody.
Morning.
Welcome to tax planning using private corporation. I'm just going to do a quick intro here. Yeah, so I run a practice in Investors Group, and increasingly in my practice we have focused on strategies around business owners. And my background, I'm a chartered accountant. Not in your caliber, though. Ram is a chartered accountant with an active accounting practice, and I'm a member in the CPA's in-depth tax course, and I have an MBA. I spent a lot of time previously working in private equity. So I'm fascinated by the areas around funding of business owners, funding business owners' projects, making connections for business owners, and showing business owners the secrets, the tips to get funding into their projects, right? And that is one of the breaking points for many business owners, right? Now, typically, I consider that the primary work of a business owner is risk management from the point of the idea formulation, the development of the strategy, and the execution of the strategy, and tax management when you begin to make money within that organization, and then creating liquidity event in that organization or company or corporation for the business owner so that you can begin to harvest some of the value you have created in the business, and succession, transferring the business to the next generation. All of these steps and all of these processes in the business owner's life cycle are fraught with risk. Now, whether he knows it or she knows it or not is something else. But the more a business owner comes alive to identifying, recognizing, and understanding what are the risks in the environment in which I'm operating, the smarter the questions the business owner would ask themselves, and the better the decisions, right? Because I consider that risk is in a spectrum, right? The more risk you take on, there's always a trade-off between risk and payoff, right? So that trade-off happens in a systematic and profitable manner when you come aware to what are the risks I'm taking on. So in my practice, we continue to help business owners focus on where are the risk areas in our undertakings, and what are the tools we can use to assess the risk, that we can use to quantify the risk, that we can use to diversify the risk, and possibly what are the tools we can use to neutralize the risk. So the more we ask those questions and provide information regarding these strategies, the better support we can provide to business owners. Today, we want to focus on the risk area around taxes, right? Kenneth, I know you will speak to the point that the tax environment carries risk for the business owner, and the more we understand what those risks are, how is it risky? They are regulatory risk, and the tax planning helps to identify, manage, and neutralize those. So today we focus on that, and Kenneth is going to assist us to do that. Kenneth, please, you take the floor. I know you make an introduction and take us through the next 40 minutes. Okay. Thanks, and then I can come back in and do a closure.
So my name is Kenneth Keung. I'm a director, one of the 6 directors of Moody's Gartner Tax Law. So we are tax specialists. And so all we do is tax. So unlike Remy here, who is a accountant who do everything, including tax, all we do is tax, and we specialize in tax. We talk and brief tax. So in fact, a lot of the work we do is we work with other accounting and law firm for specialized tax problems, such as specialized tax planning techniques, reorganization, company split up, acquisitions, divestiture, all those. Anytime there's a transaction, there's usually complicated tax implications, and that's when we get involved. So before I start on the meat of the presentation, just a bit of background. Prior to July 2017, Canada, I won't say Canada is not a tax haven, but amongst OECD countries, it has a fairly favorable tax regime for both public and private companies. At small business rate of 12% in Alberta, or general corporate rate of 26, 27, it isn't that bad when compared back then to the US corporate rate of 35, plus state tax, which can add another 10%. So it was all fine until in the budget of 2017 in March, the government announced that they are now looking into studying the whole topic of private company and their owners, the taxation. So they gave some hints of what they're looking at, but nobody really saw what was coming. And then on July 18, 2017, they made the shocking announcement basically, and turn everything upside down. For example, income sprinkling, which always has been allowed for say dividend income, they're going to shut that down. Capital gain exemption, so everyone here have a lifetime capital gain exemption of around $835,000 per person, lifetime. Everyone here, including your spouse and your children and your parents, everyone. So they were going to shut that down completely too. People were trying to multiply that. So I've seen companies sell of where $40 million of capital gain has been completely tax-free by multiplying the capital gain exemption for each person in the extended family. And then because of the tax rate differential between dividends and capital gain in the country, which the government itself created, people were trying to convert dividend income into capital gain by certain techniques. So they were going to shut that down as well. But in doing so, the rules they proposed were so intrusive and broad, they pretty much made doing business impossible or succession planning impossible. And finally, they were going to put in, they said they're going to do highly tax, they're going to subject corporate passive income to a punitive tax regime because corporations are investing with corporate dollars, which are lower tax than personal dollars. Therefore, they're going to tax it at about 70% investment income in a corporation to get it back to an even footing with a regular employee. So when these proposals came out, they said, this is a consultation. We're going to give you 75 days to comment in the middle of summer, thinking that nobody's going to really know what's going on and they can slip things through. But people like us who saw and figured out how ridiculous the rules are, a lot of us, in fact, all of us spoke up and we were very, very active. In fact, like Kim Moody, who's one of my director here, the director in the firm, he said over the past 30 years, he had never seen people being so worked up about tax changes. In fact, over that 75 days period, there were 21,000 submissions from Canadians protesting the changes. So what the government had to do was they stepped back from a lot of these proposals. For example, they were no longer, the rules about converting dividend into capital gain, they abandoned those. Income sprinkling, they said they will come up with a new version of the rules, which are more simple, in which they They kind of did on December 13th. We now have a second version of the income sprinkling rules, which I'll go through in some detail. And then that lifetime capital gain exemption, they will still allow people to multiply lifetime capital gain exemption. But they are going to plow ahead with the corporate passive income rules, which when we heard that, most of us tax professionals were actually quite surprised. Because to us, multiplying lifetime capital gain exemption to your kids and everyone else seems to be the most abusive of all, right? You get millions and millions of completely tax-free gain. But they're going to allow that. But they're going to target income sprinkling with your spouse, which to us doesn't seem all that abusive at all, because as business persons, you all know how your spouse have contributed to your business, even if they're not directly working in it. But I think the most damaging of all will be the corporate passive income proposal, because they didn't take into account the psychological and practical impact of taxing someone at 70%. So anyways, with that, let's go into some of the specific topics. So income sprinkling, you probably know what income sprinkling is. It's, let's say if I'm in a high tax bracket, and let's say my spouse is not, then I would try to divert income to the hands of my spouse so that I can use her personal tax credits, so that the first $10,000 of income is completely tax-free, and then use her marginal tax rates, right? The cash benefit of using someone's marginal tax rate and their personal credit is around $35,000. That's the cash benefit of using someone's marginal tax rate. So that's income sprinkling. There's already limits in the Income Tax Act today that limits income sprinkling, such as there's the kiddie tax. If you try to pay a dividend to your child under age 18, it will automatically be subject to the top marginal tax rate, which in Alberta is 48%. So 48% for regular income. For dividend is either 32 or 42%, but for most private companies, it's going to be 42%. There are attribution rules, so you can't just gift $1 million to your spouse and have your spouse invest in a portfolio investment. Like that portfolio income will all attribute back to you. Right, so those are the income attribution rules. And expenses, if your company try to deduct expenses such as salaries and that amount is unreasonable, that deduction is not allowed. So there are already limits to income sprinkling. But what they're proposing to do, or what they have came out with draft legislation, the version 2 of the draft legislation on December 13th, is to expand the kiddie tax. Remember I said, under existing rule, if you pay a child under 18, subject to the top marginal tax rate, they're going to apply that rule to everybody, okay? So you should all have a flowchart. Simplified TOSI flowchart. The other one, yeah, 1 page. I'm going to spend the next 5 to 10 minutes walking through this. This is my simplified, boiled down explanation of how these new kiddie tax or TOSI rules will work. So, first of all, it applies to a specified individual. Everyone sitting here is a specified individual. It used to be only kids under 18. It's now everyone resident in Canada. So it's going to be a yes. So next is, are you earning any types or any following types of income? And A is it a private corporation taxable dividend? And that would probably be the most common one. Any one of you who have a private company and you try paying a dividend to yourself or to your family member, it is all like that, it all meet that criteria. And other things that could meet that criteria is income from a partnership in which a related person is involved, or income from a trust in which a related person is involved. Oh, upstairs, okay. Also capital gain. Capital gains on, say, private company shares are now all potentially caught into these rules, these TOSI rules. So you have one of these types of income, so you continue down the chart. So yes, do any of the four, so now you're all caught, unless you meet one of the many exclusions. So we're now into looking at whether you fall into one of the exclusions. So do any of the following apply to you in respect of the income or capital gain property? A and B are you under age 25 and did you inherit the property either from your parent or from anyone if you are a full-time student, secondary school student, a post-secondary school student? If that's the case, you get a get out of jail free card, at least up to age 25. And any dividend you earn or capital gain you earn from that inherited property will not be subject to these rules. C, was a property transferred to you with respect to a separation or divorce, a judgment or agreement? Let's say I own a company, and let's say my wife divorced me. And as part of the separation process, I have to gift half of my shares to my wife. Going forward, she can get unlimited amount of dividends from my company without the application of these rules, right? D, was it capital gain arising as a consequence of death? Under the previous version of the rules, so as you probably all know, if you pass away today, all your property are deemed disposed of at fair market value. So all accrued gains are triggered. And under the previous version of the rules, it would have caught those capital gains as well, which is why you saw on there were newspaper article that talks about how you can get into a 93% tax bracket if you die with shares. So that is no longer true because they now carve out capital gain arising on death from these rules, which is great. E is important and may actually apply to many of you. Was it taxable capital gain as a result of disposition of qualified farm efficient property or qualified small business corporation shares? So qualified small business corporation shares are Canadian small business corporation, which pretty much all of the assets are active business assets, and you hold the shares for at least 2 years. If that's the case, that definition was previously mostly used for the lifetime capital gain exemption, right? If you sell shares to the QSBC, Qualified Small Business Corporation shares, you get that lifetime capital gain exemption of $835,000. And now, under these rules, even if you don't claim that lifetime capital gain exemption, let's say you already claimed it in the past or you're just not claiming it, if that corporation qualify for that QSBC definition, any capital gain will not be subject to these rules, which is actually a very great planning tool because, as I'll talk about later, there are now, they still allow ways for you to convert dividend into capital gain. So it's kind of a loophole where you can avoid paying dividend and getting a capital gain instead, and you will be outside of these rules, and you will be paying tax at capital gains rates, assuming that you maintain the company as a QS, Qualified Small Business Corporation. F, there's a special rule for when the active spouse turns 65 or when that active spouse is deceased. In that case, the remaining spouse, the other spouse can get unlimited amount of dividends from the company without these rules applying. So that's to mirror the existing pension income splitting rules. So that's good. They put that in. They put that in. But if you don't meet any of those exclusions, we now get into other exclusions that depends on age. If you're under 18, then pretty much the current rules apply. There's not much you can do. It will be, unless you meet those couple questions I talked about before, it will be TOSI income, meaning top marginal tax rate apply, no personal credits, if you're under 18. But things get more interesting if you're age 18 or over, such as, for example, your spouse. First, you need to ask, is it income or gain derived from a related business? So what is a related business? Is either a business in which a related person of yours is involved in, or a business in which a related person owns at least 10% directly or indirectly. So for example, say me and my wife, in my professional corporation, my wife is also a shareholder in my professional corporation. She doesn't do any, even though she's an accountant herself as well, she doesn't do any work in respect of my professional corporation. So, but the professional corporation's business is a related business to her. If my corporation pays her a dividend, that dividend will be from a related business, and she won't meet this exclusion, and she is potentially caught unless she can get into one of these exclusions later on. All right. So let's say it is from a related business.
You're saying something about you and your spouse. Is it okay to ask questions? Is it okay to ask questions?
Can she ask questions now, or should she save the questions?
Well, if it's directly related to what I'm talking about, sure.
Yeah. Okay. Now, what I wanted to ask is, from what your wife is getting from your business, she's supposed to pay taxes on it as well, separately from what you are paying.
Yeah. But yes, but in the past, she'll pay tax based on her marginal tax rate. Let's say she doesn't earn any money herself at all.
Yes.
She'll be paying very, very little tax on that dividend. But now, she'll probably be paying top marginal tax rate. So 40, if it's a dividend, so 42% tax on every single dollar of that dividend. Because it's from a related business, and in her case, she won't meet any of the exclusion as I will talk about. So if it is from a related business, so you keep going down, you look at whether it is an excluded business. So to meet that exclusion, you ask, is that person actively engaged on a regular, continuous, and substantial basis in the business in the current year or any 5 preceding years, either on a factual basis or by meeting a threshold of average 20 hours per week? So going back to my case, the case with my wife, because she doesn't work on a regular, continuous, substantial basis in my professional corporation, nor does she work 20 hours per week on average in my professional corporation, she will not meet the test. But I will. My professional corporation is carrying on an excluded business for me. I can receive unlimited amount of dividends from my PC, but she cannot, because it is not an excluded business for her. And that five-year test is actually pretty generous, because it means that as long as I work full-time for 5 years from my professional corporation, I'm forever out of it. This will forever be an excluded business of mine. So let's say my son takes over my business a couple years down the road, I can get dividends and capital gain from my corporation forever without these rules applying.
Is this effective
Right.
2017 or 18?
These rules apply January 1st, 2018. Even though it's subject to royal assent from the government, it likely will pass. And then if it is not an excluded business, such as, say, my wife in terms of my PC, professional corp, you then look at whether she is age 25 or over or between age 18 to 24. In this case, she is age 25 and older. So maybe she can fit into the excluded share exclusion, which you need to meet the 4 conditions below here, which is less than 90% of the corporation's business income last year was from providing services. B, corporation is not a professional corporation. C, she personally owns shares that gave her at least 10% of votes and value of the company. D, less than 10% of the income of that corporation was from another related business. Let's just draw that out. Me, Kenneth, and my wife, Danica, we both own shares of a professional corporation. She owns 1/3 of the shares. I own 2/3 of the shares. Well, it's a professional corporation. I'm already out. I can't get this exclusion because it's a professional corporation. What if it's a butcher shop? I sell meat. Well, it is not a professional corporation, and the business income is not from providing services, although maybe cutting up meat is service, but who knows. And both me and her, we own more than 10% of the votes and value in the company. And the income of the company is not derived from any other related business. So I'm fine. Like both me and her are, these shares are excluded shares. As long as it is excluded shares, you can income split or income sprinkle all you want, both income and capital gain. Unlimited amount of dividends to the wife, to me, doesn't matter. You don't need to prove anything other than that these are excluded shares. But what is the percentage of business in Canada that is not services? I think about 80% of Canadian business are service business. For example, this is a construction company. Construction company provide construction service to other customers. Well, that's a service business. You can never meet excluded shares. You're out. Barber shop, cutting hair, you're out. Most IT business, they're service provider. None of them can get this exclusion, which in my mind is a bit too broad, right? Because this is a very, very generous exclusion. If you meet this exclusion, you can income split all you want. But if you're not in this exclusion, let's say because you own a service business, or if your corporate structure is more complex, you likely won't be able to get this exclusion. So let's say the answer is no, you don't get this exclusion, such as me, because it's a professional corporation.
So, in the construction, even if it's active business, it's still considered a service?
It's a service. Unless you are buying the old house, constructing and selling the house, then you're selling goods. But if you're just developer, then maybe you're fine, because you're selling goods and not selling services. So let's say the answer to that is no. Yeah.
What's the consulting? Doing some engineering consulting? Would that
Service for sure. If it's just consulting, and that I think that's what these rules are really targeted to. The government don't like professional corporation. We all know that, but they also don't want professional-like companies to get these rules, which is like engineering consulting. They don't like that. So they said all those companies are out. But by the way they drafted these rules they also catch things that are not just consulting too, which is the problem. So no, then the last you're left with reasonable return. So the amount of the income that is reasonable based on the work performed, property contributed, personal risk assumed, and historical remuneration and any other factor. If you can justify, let's say my wife here, if I pay her an $80,000 dividend, I will have to justify based on the work she performed, the risk she assumed, the contribution she made. If I can justify, say, $30,000 of the dividend is reasonable, that $30,000 will be okay. It will be based on her marginal tax rate. The rest, the $50K, that is outside what is reasonable, will be top marginal tax rate automatically. Okay?
So if you fall in that exemption, you still have to qualify under a reasonable test?
Say that again, please.
If you still have to qualify a reasonability test even if you're in exemption?
No, if you meet, it's like a 4-to-4 test. Like if you meet any of the exception previously, like exclude a share, you don't care about reasonable return. You can do whatever you like. So I'll take this flow chart with you. Yeah. Mm-hmm.
So the only way to end the exemption is to be a producer of some goods, right?
For that excluded share produced, yes, to be a producer of goods.
Like producing energy products or
Producing energy. Yeah, it depends on where the producing energy is a good, but let's say it is, then you'll be fine. If not, you have to prove reasonable. Prove the amount you pay to your wife is reasonable, or your kids are reasonable. Yeah. And then there are separate rules for age 18 to 24, which are much more restrictive, which I'm not going to go through. But you can take this with you. So the good news from all this is You can actually still income sprinkle if you fall into one of these exclusions, if you're lucky enough to fall into one of these exclusions. But there are other ways. They have left out, these rules left out certain traditional strategy for income splitting, which are still allowed for some reason. So let's say me and my wife again. So I cannot income split anymore with my wife through my professional corporation. But hey, I can still do this. Let's pretend I have $1 million cash. And let's say I'm at the top marginal tax rate, but let's say my wife Danica makes no money and she's at the lowest marginal tax rate. So what will I do? Maybe I can loan the money to her. Remember I said earlier, if I just loan the money to my wife and she makes money, that income is attributed back to me. But if you charge at least the prescribed rate of interest, which currently today is 1%. As long as I charge 1% on my loan, she can then take the money, $1 million, and invest it in whatever she wants. Let's say it is with asset like mutual funds, and earn 8%. This 8% will be reported by her, and she can deduct the 1% she pays me. It will be taxed at her marginal tax rate, which will be pretty low. I will, of course, have to report that 1% in my income, but 1% on $1 million is only $10,000, right? So I'm getting a pretty good deal out of this. One key thing is to remember is they have announced on April 1st, 2018, this rate is going up to 2%. So if you were to do this, you probably want to do this before April 1st, 2018, because after that, you need to charge at least 2%, reducing your potential to income splits. Taking this strategy even one step further, you can, instead of, let's say I have my wife and 2 kids. What if I set up a family trust? And the beneficiaries are my wife and my 2 kids, and say they're even minors. I can do the same thing. I can loan money to my family trust and charge the prescribed rate of interest. The family trust can invest in whatever it wants to invest in, like say portfolio investments. And then that investment income can be allocated to all of the beneficiaries to use their marginal tax rates. So as I said earlier, each person you can income split with is worth about $35,000 at the maximum. So 35K saving, 35K, 35K. So you have just saved over $100,000 potentially. There's a risk to this. If you look at that flow chart, one of the types of income that is potentially called is trust income, if it comes from a related business. If this is just buying GICs, it is probably not a related business because it needs to be a business. Buying GICs is probably not a business. But we don't actually know when it becomes a business. So let's say you're buying and trading stocks. A CRA could come and say, well, this is a business, and because a related person is managing this is a related business, so every single dollar you allocated to your wife and kids, they are all caught. They're all subject to top marginal tax rate. You're out. So that is a risk if you try to do something like this. But there are many people who are going to risk it and to try to get around these rules. As I said, you can still multiply capital gain exemptions. So for example, let's say you have an operating business. Let's forget the loan. So you set up your business so that all the common shares of your operating company, let's say it is a qualified small business corporation, these common shares grow in value, and 10 years down the road, you sell the company for a humongous capital gain. That capital gain could still be allocated to all of your family members using the family trust, but you actually have to pay them, of course, if you're allocating income to them. And you can use up each of their $835,000 of lifetime capital gain exemption, which could shelter most, if not all, of your future capital gain on these shares. So you can still do planning like that. And then paying salary, I'll talk about this a bit later, or I'll talk about it now. So you will notice in this flowchart, TOSI flowchart, it doesn't catch salary, all right? So me and my wife, as I said earlier, if I pay a dividend to my wife, and let's say she did no work, no contribution, no risk whatsoever, and I pay $100,000 of dividend to my wife, since it is a dividend, it is not an expense to my company, okay? No deduction in the corporation. My wife will have to, because it's unreasonable dividend, she has to pick up the entire thing at marginal tax rate of 42% for dividends. Versus, what if I did this? Option one. What if I pay her $5,000? I can probably justify $5,000 of salary as reasonable. In that case, my company get a deduction of $5,000, and she picks up the $5,000 at her marginal tax rate, which if she earns no other income, that means zero tax. So that works. But what if I pay her $100,000 of salary? Obviously unreasonable since she didn't do any work for my company. Okay, as I said earlier, unreasonable expense not deductible by the company. But if you think about that, that's like the same as paying a dividend. You can't deduct the dividend anyways, so you don't deduct the salary. But when the wife gets the salary, it is not part of that flowchart. It's not caught by these rules. She can still use her personal credits. She will still use her marginal tax rate to report that salary income. So you are actually better off paying an obviously unreasonable amount of salary than paying a dividend, if you know you cannot get out of these rules. But in this case, if you're paying an obviously unreasonable amount of salary, you should not be deducting it in your corporation, because if you try doing that and the CRA catches it, it will probably be a gross negligence penalty. So if you try to do that, you probably would be upfront and say, this salary not deductible. But you know what? Corporate tax rate for small business is only 12%. You're paying a 12% hit, but then your wife is picking up at the income at a very, very low rate, potentially. Corporate passive income. So that's the other thing. So there's no rules for these yet, because it's still part of a consultation paper. But the Liberals has clearly stated that they are going to push ahead with this. So what is the underlying rationale for doing this? So right now, let's say I'm an employee. Let's say I'm at the top marginal tax rate, and I make $1 million of salary. My personal tax rate is 48% at top in Alberta, but let's say, to make it simple, let's say 50% is my personal tax rate. So I'm left with $500,000 of after-tax money to invest, all right? And any investment income is also taxed at 50%. So 50% tax on my investment income starting with $500,000 of capital. But what if I do business in my corporation? I have an OpCo. Let's say OpCo earns $1 million. And let's say between the small business tax rate and the general tax rate, I pay about 20% tax, corporate tax. I'm now left with $800,000 to invest. Yes, when a corporation earns investment income, it is subject to a special high rate of tax, actually 51% tax on the investment income. But under the current rules, 31% of that is refundable. It is refundable when the company pays enough dividend to me. So on a net basis, the corporate tax rate on investment income is only 20%, okay? And then when the company pays that dividend to me, I pay tax at 42%, at top marginal tax rate. So what is, in total, what is the tax rate on my investment income? Well, let's say I earn $100,000 of investment income, subject to 20% tax, so I have $80,000 left to distribute. 42% on $80,000 is about $30,000 of tax. So I have $31,000 of personal tax plus 20% of corporate tax is around 53%, around there. That's the total tax rate investing in a corporation, which of course is slightly higher than personal tax rate, But the benefit of this is I'm using corporate dollars, meaning I'm investing with 800K to start with. And you probably know, based on the power of the rate of return and time, you end up with a lot more money in your pocket under this scenario than this scenario because you're starting with a bigger capital. And that's what the Liberal government didn't like. They said, we don't want you to be able to earn more money, have more money in your pocket at the end of the day than an employee. So what they're going to do is they're taking this away. Even if the corporation is paying you the dividend, you will still be subject to 51% investment tax, which, if you do the math, so that means 400K of tax here, and you are left with 400K to pay out. That's another personal tax on for 400K is about another 1670. So anyways, you will be left with, your total tax rate will be 70% after the new rules on investment income in a corporation. If you don't, let me show you. So 400K of corporate tax, you're left with 400K to pay out. 400K times 42%, that's around 160K. So your total tax is 560. 560 divided by 800, that's around 70. And some provinces, this is even more. All right. What if it's capital gains? What if it's capital gains inside a corporation, right now versus in the past? Right now, let's say the operating company have assets that are worth more than the cost. Let's say the capital gain is $1 million. Right now, for $1 million of capital gain, only 500K is taxable at 51%. But as I said, 31% is refundable. So you're left with 20% tax on that 500K. But then, under current rules, the other non-taxable portion of $1 million, meaning the other 500K, can be paid out completely tax-free to the shareholder, completely tax-free. The taxable part, meaning, well, because this means $100,000 of corporate tax, right? So you're left with 900K, of which 500K was paid out tax-free. The other $400,000 is a taxable dividend to you, taxed at 42%. 42% of 400K, that's around 160K. Total tax, 160 plus 100 is 26%. What they're going to do, same thing, they're taking away this, 31%, gone. This, no more. No more tax-free dividend. The entire thing, you will have to, so first of all, your corporate tax now becomes 51% of 500K. So corporate tax is now 250K. You're left with 750K to distribute. And that 750 is going to be subject to 42% tax rate. So that's, say this is 350K of personal tax. 350, 250. Your total tax rate on corporate of capital gain inside a corporation is now 60, going from 26. If you work this all out in a spreadsheet, it all works theoretically because it will drive your the net money in your pocket at the end of the day back to what you would have got if you were an employee investing with a much smaller pot of money at the beginning. And that's why it is so appealing to theoretical economists because, see, it's neutral now, right? You can make more money as an entrepreneur than an employee. Of course, that completely ignores the psychology of business owner. Like, are you going to invest your hard-earned corporate dollars into something risky to earn a return that is subject to 60 or 70% tax? No. You're just going to buy at most GIC. If you're going to be subject to 70% tax, you probably just buy GIC, right? You're not going to risk it all and only keep 30 cents. But there will be exemption. They said there will be exemption for like angel investors, and probably, I'm guessing there will be exception from this rule for investing in more than 10% in a private company. So you can probably invest in your local butcher and buying like 10% of their company. You'll probably be fine. But if buying mutual funds and portfolio investment, no longer fine. So people were really angry, and they came and said, oh, you know what? Don't be angry, because what we are going to do is we're going to grandfather all your existing investment in the corporation. We don't know how they're going to do this or what they're going to exactly going to grandfather. But if that's true, that means for all of you who are successful business people with a lot of passive assets in your corporation right now, those are supposed to be fine. The old rules will still apply. But, oh man, this is going to be a nightmare to track, right? How are you going to track down the road whether this money came from the old pot of money, especially when you flip things around and turn things over? And on top of that, on top of the grandfathered assets, they said the first $50,000 of passive income will be subject to the old rules and not the new rules. Again, going to be super complicated, and doesn't. We will see. Like for example, with interest income, you can see maybe 50K coming in. That's like equivalent to a $1 million, $1.5 million portfolio. But what if it's capital gain? Capital gain don't get triggered every year. You build capital gains build up until 1 year in the future, it all get realized, and that's going to be probably more than 50K because it's accumulation of all the years, accrual, right? Appreciation, and also we're not sure if that's $50,000 per shareholder or $50,000 per company. What if you have 10 shareholders in the company? Well, 50K would be not very much money for 10 shareholders.
So what's the incentive for keeping your money here in Canada as opposed to moving a major portion of that to offshore banking?
Yeah. So, well, right now we just don't know what they're going to do. We will see the rules when they come out, budget 2018, hopefully, and then we can see. But right now, it is not a bad idea to, instead of moving money to someone in Canada, moving it to a relative, not in Canada. If it's not owned by a Canadian resident, you should be out of these rules. Or maybe it seems like under these rules, you can maybe, instead of investing in the operating company, maybe setting up a foreign offshore company, let's say even US company, and then investing it under that company's, foreign company's name. And it kind of look like you will escape these rules completely, kind of. Because you'll be subject to a different regime, which is not going to go into details here.
And what's the implication of that for MTL auditors?
They will, well, if I'm Department of Finance, I would foresee people would do that and would put in rules to prevent that.
Right now, there's a loophole.
Right.
Yeah, there's a
Based on the news release and what we know, right now there are loopholes, which they may completely close down if I'm Department of Finance and wanted to do this. Because otherwise it would just be completely unfair. And this whole grandfathering thing is actually really unfair too, because everyone here is super successful business people who already have accumulated many millions in the corporation, and you're fine under the grandfathering rules. But how about the next generation? People starting up the business, they will be subject to 60-70% tax rate on their passive investment, whereas the successful people here is subject to 26 or around there. So inherently, that is not fair, in my view. The government boasts about they have reduced. So when the public was really angry, they came in October and they said, oh, you know what? We're going to reduce the small business tax rate. Okay, and that's what they keep emphasizing. They have now reduced the tax rate for small businesses. Well, what's wrong with that was a big part of why do we have a problem like this? It's because the rate differential between corporation and individuals are too high. If you earn money in your individual hands, 48%. Earning in a corporation for small business for first 500K, 12% tax. That differential is too high. That's what's creating all these incentives for people to do this mischievous stuff. And now they're lowering the corporate tax rate even more, right? Which is further worsening the problem. But is it really a tax reduction? What they didn't talk about is, yes, they are going to reduce small business rate from 12.5 to 11% as of 2019. But at the same time, they're going to increase the personal marginal rate on dividend from 41 to 42.56 in Alberta. So there is no actual tax reduction. At most, it's a deferral of tax because they're going to tax you on the way out anyways. So, and also, if you have retained earnings you have not paid out yet, you know what? All the existing retained earnings is now, instead of subject to 41%, it's now subject to 42.5%. It's actually a tax increase on all your existing retained earnings you haven't paid out before 2018. So this is not really a tax reduction, despite what they say. Lastly, I'll touch on surplus stripping. So as I said earlier, people try to convert the dividend into capital gain. And many are very creative in trying to find ways to do that. Because there's a big difference between tax rate on dividend, which is between 31 and 42%, and capital gain at 24. So government on July 18th, they shut that all down. But now, they abandoned those proposals so you can still do this. So for example, let's say me and a corporation, I'm an OpCo. I was going to take out $1 million as a dividend. It's going to be a non-eligible dividend, let's say, so it'll be subject to 42%. All right? That's my base case. What if I do this instead? What if I do a internal share exchange? I cancel these shares, and I got new shares, and at the time of doing so, I managed to trigger a $1 million capital gain, on which I have to pay tax at 24%, because only half is taxable and half of 48% is 24. When I do that, I have high cost-based shares. And then I have to do a next step, which is transfer these high cost-based shares into a holding company. And then from these holding companies, I would be able to extract money from this holding company. I will extract $1 million tax-free. It's slightly more complicated than that, but at the end of the day, I still took out $1 million. But instead of paying 42%, I'm paying 24%, right? So you just saved 18%. So these kind of planning, there's many, many versions of this. That seems pretty artificial to me. So I didn't know why they didn't shut this down, but they didn't, at least until new rules come out. So there are people who advocate actually doing this now, before the budget comes out in 2018 this year, between March and April, where they may shut this down. So because if you do this, you can actually prepay like a couple years of income at this lower rate, and to avoid this. So something to think about. Summary, 2017 proposals. It's very adverse for private company and shareholders. And I glanced over a lot of the complexity, but it will be very complicated. Like Remy here, every time you do something simple, like simple as state freeze, you now need to go through this and analyze this. Every single accountant will have to charge a couple $1,000s more, even doing very, very basic transactions. And that's unavoidable because of so much complexity being introduced. I think other than me and Remy here, nobody are professionals, but clearly they hate us. But we're not going to go into that. I'm not going to go through this, but the other, so I handed out, because I thought that this one also have a flow chart. It would be neat to show you. They introduced new small business deduction rules 2 years ago, and it is also extremely complicated. If you only have one corporation and doesn't do any business with any other related company, you're in luck because you're not inside these rules. But if you have anywhere close to a more complex situation where you do business with other family businesses, you actually may not get that 12% small business rate that you think you can get, because you have to go through these rules to figure out if you can, which are also extremely complicated. So that's just one of the examples of how the government is really focusing and attacking small businesses in Canada. And you know what? I'm fairly left-wing myself in my social views, but man, these rules are just kind of ridiculous, no matter what your political leanings are. Change. What we are seeing, like some taxpayers might merrily go along, taking most things for granted, but truly, people have lost so much faith in the government because of what happened with the tax changes. Not just tax professionals, but common people seeing what's going on. They see the government really going hard attacking the business, and even though they backtrack a bit, but we've seen a change in psychology. People are way more aggressive than in the past. In the past, many business owners would say, oh, you know what, I'll pay my fair share of tax, and I just want to be safe and not be subject to risk. We're actually seeing business owners that come and say, you know what, show me the most aggressive planning you can. At least show me, because I don't trust the government. I want to, there is a change in psychology, which is great for us tax geeks because we can think about really cool stuff, but I can't see how this is good for the country. What can taxpayers do? So look at every way to income split, various strategies with a new version of rules, such as all those exclusions I highlighted in the flowchart. Maximize tax deferral in corporation. This is still true. Remember, corporate tax rate, at least for the first 500K of income, only 12% tax, if you can get the 12% rate. And even after the 500K, is 27% in Alberta. Both of those two numbers is a lot lower than over 40% of personal tax rate. So if you don't need the money personally, it is generally advisable to leave it in the corporation, unless this new passive income proposal rules completely hammer you with respect to investment income. But that's another story. And if you are paying out salary to yourself, maybe even unreasonable amount of salary, think about maximizing RRSP. So a simple planning would be, if you're going to take out, say, $500,000 anyways, at least make your salary to be, I think, $230,000. So you maximize your RRSP limit. So you can, because for personal tax planning, RRSP truly is a great tax planning tool. It gives you immediate deduction and tax-free growth, right?
So, excuse me, how do we make inroads into the mindset of people to drift a certain percentage of that excess into nonprofits like NGOs and so forth? How do we present ourselves that way? Because that's what I'm into.
We'll talk about that offline after, okay? Because that's pretty niche discussion. Corporate life insurance. So two things. If your corporation buys life insurance, the premium is not deductible, but you're using after-tax corporate dollars, which is only either 12% or 27% tax. So much cheaper dollars than personal after-tax money, all right? And the second thing is, it looks like the life insurance, the income that is earned inside the life insurance that is owned by a corporation, it looks like it will not be subject to these passive corporate 70-60% tax rules. Looks like. We don't know yet, because the rules hasn't come out, but it looks like it will be outside of those rules. So which kind of create a loophole for corporate life insurance as well. You can still multiply capital gain exemption and talk about if you have non-resident relative you can trust, maybe if you do a freeze today and you issue your shares to a non-resident relative, right? And they're completely outside the Canadian tax net. Of course, it has to be a true economical event. You're actually giving them the shares and actually giving them the money. But if you were, say, going to remit money to your relative in, say, Asia anyways, you may as well make that relative a shareholder There will be Canadian withholding tax, but still a lot lower than the 40-something% tax you have to pay and then give that money afterwards. I talked about prescribed rate loan strategies. Lastly, you know what? We're doing a lot of these right now. A lot of super high net worth individuals are actually leaving Canada, not only because there's more tax in Canada, but just the overall business environment in Canada isn't great relative to other countries, such as right now the US. When you leave Canada, all your assets are deemed disposed of at fair market value, but there are ways to mitigate that and defer that. But a lot of these individuals are leaving either because they want to seek better opportunities elsewhere or they're retiring to warmer climates. And then once you're gone, you're outside the Canadian tax net. Grand finale, all this tax changes has to be viewed in relation to our biggest neighbor down south, the US. I'm sure you all heard about all the tax changes down south in the US. They're going a completely different direction. Not going to go into details, but what they're doing is making it really, really, really attractive right now to invest in the US. And given the better business environment, better weather, way better tax regime, Canada is in a real competitive disadvantage at this point, unfortunately. Like just quick example, like corporate tax rate in the US used to be 35%, just federal. It's now 21, right? That's an immediate 14% decrease in your corporate tax rate, which that in itself says a lot in terms of how the two countries are viewing business. Encore places, lots of other places to go. If you want to move, for example, you can move to Barbados. No tax on foreign income at all, because let's say you have all your investment assets with Osasol earning income from Canada or US. If you move to Barbados, you're not subject to tax on any foreign income, so no Barbados tax on any income you earn other than the Canadian and US withholding tax of between 15 to 25%. A whole lot better than 48%. So I think that's all I want to cover in the short time I have. Yeah.
Thank you. Good job. So I want to just add a quick follow-up to that. So whether you choose to pay reasonable or even unreasonable salaries, Kenneth says that's a good strategy for us to do now, right? So when you pay with after-tax dollars, with the note or whatever notice that this is not tax deductible in this salary has not been deducted, strategies, we continue to look at where are the last tax sheltered havens, right, for business owners. So I just want to quickly add this to your notes. Kenneth said about RSP. Maximizing RSP is more important now than ever before. And then you can also, as a business owner, look at the strategy of building yourself your own teacher's pension plan, in quotes, right? And that would be it's a registered pension plan, but in this case, it would be the individual pension plan, which based on 3 factors, including aged, length of time in service, and the T4 earnings itself, it would provide typically more room than the RSP deductions, and it is tax deductible. There are expenses regarding the creation of the structure of it, but all of those expenses are tax deductible, right? So, and then it provides lots of, we can't go into the details of how this technique works right now, the technical aspects, but it provides very great benefits in addition to the top up that the government allows you to do if what your holdings in this plan. The government requires 7.5% minimum performance rate, but where you have shortfalls there, it gives you the opportunity to add more money tax-free, and that is beneficial. Then you can even turbocharge this and look at the retirement compensation arrangement, right, for business owners, right? That's the RCA, which is another interesting vehicle, right? And of course, there is the insurance policy, corporately held insurance policy, which provides immense benefits. Right now, that continues to be one very important corporate insurance policies, a very important add-on when you have explored the other vehicles. And of course, there should be insurance need, right? For a business owner, personally, I think the insurance requirements for a business owner are a very strategic aspect in your risk management framework. So I would say thank you to every one of you on that note, and would like to keep you put you on notice regarding upcoming opportunities we have. We'll be looking at other strategic areas that are important to the business owner, including funding strategies and strategies concerning building sustainable, supporting charities in the framework of your business arrangement. Thank you very much for coming out, and let's give yourselves a clap.
Thank you.
Thanks, Kenneth.